Hello everybody, it's Yashar here, back again with another video, and in this video I'm going to talk about top 5 recession-resistant Canadian stocks. Recession simply means temporary economic decline when consumers spend less money and business activities are reduced, generally defined by a fall in GDP for two successive quarters. A lot of economists predict that we will experience a recession in many Western countries in the coming months due to economic ripples of pandemic lockdowns, war in Ukraine, supply chain issues, and of course inflation and interest rate increases. During recession, usually the growth-focused businesses and zombie companies hurt the most. By zombie companies, I mean businesses who cannot generate enough cash flow to service their debt and fund their operations. These companies' growth rates and revenues will fall the most in a recession as they cannot borrow money like before and there are not enough buyers out there to support their businesses. The stocks I'm talking about today are different and they tend to do relatively well during recessions. Recession resistant doesn't mean the share price of the company doesn't drop at all during a recession. It means the core businesses doesn't get hurt much by recession compared to zombie companies and growth-focused businesses. And therefore, these companies can maintain their revenue, their cash flow, regardless of macroeconomic events. As such, you can expect relatively less volatility in these businesses, and these companies can maintain their ability to pay their dividend and also their ability to achieve their long-term objectives much better than other companies during a recession. Of course, the list could be much longer than this if I want to include all of the Canadian recession-resistant stocks, but these are the companies that I personally like them more than the other companies. Finally, I want to mention that being in this list doesn't mean these companies are a buy right now, because honestly, some of them are heavily overvalued at this time, and I will only pick them up during a dip. Before starting the video, I want to emphasize that I'm not a financial advisor. This video is not a financial advice for you to buy, hold, or sell these stocks. This is just my personal opinion. You should always do your own research before making any financial decision. With that being said, let's start this video. The first company in my list is Loblaws. Loblaws operates in two segments, retail and financial services. The retail segment operates franchise-owned retail food and groceries, including No Frills, Wholesale Club, and Atlantic Superstores, and also Shoppers Drug Stores. This segment also includes in-store pharmacies, health and beauty product stores, and apparel stores with a brand they call it Joy Fresh. The financial services segment provides credit card, PC banking services, PC Optimum program, and insurance services. As you can see, the core business of Loblaws, which is grocery stores, is a recession-resistant business. People always need groceries even during recessions. And as such, Loblaws is a business that has pricing power and predictable revenues in any macroeconomic situation. They have a great balance sheet with consistent revenue and cash flow increases in the past couple of years, which is, of course, it is not a fast-growing business like a tech company, but still growing slowly. Even in the last quarter, they still were able to grow their revenue by 3%, which shows they can grow even during difficult financial times. They also consistently increased their dividend in the last several years, and investors usually want to put their money into these defensive stocks like Loblaws in uncertain times, and that is exactly why the stock is traded at such a premium today. If you compare the price to cash flow and price to book of Loblaws to its historical 5-year average, it is trading at a premium today, which I can understand. You usually have to pay a premium to own such a stable, predictable, and powerful business, especially in times like this when we have uncertainty in the market. Overall, Loblaws for sure is a great business and in fact a great recession-resistant Canadian business. The second company in my list is Canadian National Railway, which is a major player in transportation and basically the supply chain for North America. They transport more than 250 billion Canadian dollars worth of goods annually for a wide range of businesses across a rail network of approximately 20,000 miles spanning Canada and US. This type of business will perform very well during all types of economic conditions and macroeconomic events, as we need to transport goods and supplies even during wars and recessions. They're growing their business very fast in the last few years, and they actually project to have 20% annual EPS growth and 20% free cash flow growth just in 2022. The company consistently increased its dividend in the last few years, and with the current low payout ratio of around 40%, I believe they will be able to continue to pay out and grow their dividend for the years to come. For the reference, CNR increased their dividend by almost 24% year over year in the last 7 years, which is amazing growth rate for the dividend of the company. The stock is usually traded at a premium because of the quality of the business. But if you compare the valuation of CNR to its historical average, we can see that the company trades close to its 5-year average price to earning and price to cash flow. It is not screaming a buy here, but I think CNR is always a solid choice for investment. And in my opinion, it is one of the most resilient and recession-resistant Canadian stocks you can buy. The next company in my list is Fortis. Fortis operates as an electric and gas utility company in Canada, the United States, and the Caribbean countries, and the company HQ is located in Newfoundland and Labrador. Utility companies usually have a predictable cash flow and revenue as everybody needs their electricity, gas, and hydro during all type of macroeconomic events. Therefore, utility stocks are usually less volatile and can hold really well during recessions. Fortis, in my opinion, is one of the top utility companies in Canada, and that's why it makes it to this list. They consistently increase their cash flow from operations, and also they were able to pay out and increase their dividend year over year in the last 48 years. And 48 years of paying out and increasing dividend is not a joke. It means the company can safely navigate through all sorts of financial environments and challenges. I believe Fortis can continue to increase their revenue and dividend in the coming years because of the recession-resistant business model, and therefore it can be considered as a strong recession-resistant Canadian stock with a nice starting dividend yield. The next company in my list is Dollarama. Dollarama operates a chain of dollar stores in Canada. I think Dollarama business model is solid and it works very well during all periods in the financial cycle. They cover a unique retail space because they focus on super small cheap items like kitchen accessories, gift boxes, and gardening accessories. That would be very hard to deliver as cheaply for added shipping costs for larger retailers like Walmart or Amazon. I don't think Amazon or Walmart or even Costco will cut into Dollarama market. I think the customers of Dollarama will buy their products even during a recession as people will want to shop and buy cheap products all the time. Of course, the major risk for Dollarama is disruption of their supplies, which is mainly coming from China, but in my opinion, they are pretty much a great recession-resistant business. If we look at their cash flow and income statements in the last few years, we can see robust numbers, and of course, they don't grow super fast like tech companies, but still providing consistent small growth numbers in their revenue year over year. They were also able to pay out and increase their dividend consistently in the last several years, and I think they can continue to do so even during the recession. The last company on my list is Emera. Similar to Fortis, Emera is an electricity generation, transmission, and distribution company with an HQ at Halifax, Nova Scotia, and it operates in Eastern Canada, US, and Caribbean countries. If we look at their income statement, we can't see much growth in the revenue and income of the company for the last 3 years, which is mainly due to economic impacts of COVID, but the growth is actually coming back and we can see stable numbers here overall. They also consistently paid and increased their dividend in the last several years, which is a good sign. Because of the nature of the business, Emera is basically a monopoly in terms of the electricity transmission in Eastern Canada. And therefore, I believe their business model is a recession resistant as everybody and every business in that part of the country needs electricity and power all the time. I mean during booming economy or during a recession. There you are guys. These were my top 5 Canadian recession resistant stocks. I hope you enjoyed the video, and if you enjoyed the video, consider subscribing to the channel to see similar videos. Thank you for watching, and I see you in the next video. Farewell.